there's a lot to talk to today, so we're going to get right into it. We're going to follow the general format with Mark sharing his section and then Chuck sharing his. They both have a lot of material to go over today. There's a lot going on, a lot to talk about. So with that, Mark, why do you start us off?
All right. It's 470 pages in the handout today.
That's just your section, Chuck. Okay. Remember that your trades are your own. Okay. When we last tuned in last month, we were at kind of a potential rally high, and we were talking about if we came back into the range, it was going to be negative, going to be heading lower again, and that's pretty much what we did. The big story is inflation, stagflation, and new highs in the Fed's preferred inflation gauge, which of course measures a minute fraction of 1% of the goods in the economy. And food prices are up 75% since 2020 and counting. It's leading to a big problem for a lot of emerging markets. So inflation is the big thing. This chart didn't come out, but the bottom line is here. Basically, we've spent $6 trillion on COVID. It's 8 times more than the biggest bailout of 2008. It's a huge sugar rush for the markets. That's why they exploded. And now, basically, and that was with money that we couldn't afford. And remember, whenever you think of debt in a country, you want to think of, are you spending on things that are going to produce the income stream to pay for that debt or not? Right? Helicopter money, which is what we did, which is just handing out people money, doesn't pay back anything. It doesn't produce any income. So it's the most inefficient use of that capital that is possible. So the Federal Reserve is now on a tightrope. It pumped up the money supply to make up for lockdowns and COVID, and then because it gave people money even while they weren't producing goods. We had huge supply shortages. Now we have supply chain issues that are being exacerbated by the war in Ukraine. And then we expanded NATO to the point that Russia invaded to make those much worse. So we have all these problems with supply. At the same time, we have this huge demand, and that all culminated in a multi-decade high inflation today. Now the Fed's tightrope act begins. It's trying to tighten policy enough to bring inflation off the boil, but it's not, and still not trying to put the economy into recession. That's a real tightrope. We'll see how they handle that. That's going to be key for the markets over the intermediate term. The positive news is that the CDC has downgraded COVID to no longer being a pandemic. You can see that in the world and in the US, a number of cases have come off. There's some spot cases in China and some places in Asia where it's still picking up a little bit. It's not to former highs. In the US, the CDC has announced that 65% of US adults and 75% of children have contracted and fought off some form of COVID, and they now have natural antibodies to the virus. In recent tests, natural antibodies are testing much stronger than vaccines or anything else in repelling new and different strains that they test in the lab and in real time. So there's a good chance that the worst of COVID is behind us, although we'll have little battles with it again, but we can be on a path to normalization, and there's a chance that we've reached herd immunity levels that will repel stuff and not make it as bad in future rounds. All right, so what the markets are facing. This is the sugar rush that we've had, this record amount of QE by global central banks, and now that's turning into QT, right? G7 policymakers look set to shrink their balance sheets by over $400 billion during the rest of 2022, and every month that number is going up. So, and that's versus 2021, when they bought $2.8 trillion worth of bonds. That's a major shock. Most studies suggest that markets are up somewhere around 45 to 50% more because of QE. So when you start pulling that out, the impact could be the opposite. The thing to realize, as we've talked about before, that this hasn't come up yet, but it's basically up here, 75 to 1% Fed funds, but it's still, the Fed is still a record amount, even more than during the 70s, behind both the market neutral rate, the Taylor rule, any kind of neutral rate you want to do, as well as inflation. And that means they're going to be playing catch up very quickly. Now, one thing that we need to watch is that the TNX, which is a 10-year yield, is already, it's actually up right here and touching this downtrend line. This is a multi-decade from 1980s downtrend line in interest rates, and it's exhausting into it. It's likely that we're going to at least pause on the TNX. And it's quite possible that TNX could pause or correct a bit, even while the Fed is continuing to raise the Fed fund rate. And that could mute the impact of higher rates a bit on the economy. But we break clearly through this 3.3% level, 3.5, 3.6, we start getting up to those levels. This is a new era, and the era of disinflation is clearly over for a prolonged period of time. The yield curve did get inverted, but for a very short period of time. It's still very flat till we get over about 0.5. We're still kind of in this danger period where we could come back down. So we need to watch that. But the bottom line with this flat of a yield curve that has been inverted, and is only inverted on some parts of the curve, not on the 6-month, 30-year, 10-year curve, that you kind of want both to happen before you say it's a full inversion. Nonetheless, banks don't have a lot of incentive to lend here, and that's the real bottom line. That's what it tends to slow economies, when you get this yield curve inversion. All right, so let's see. I guess we missed another chart. So anyway, mortgage rates are at the point where $1,000, you could have bought a $240,000 home, and now it's a $180,000 home. So realize that it makes the buying power for homes more problematic the higher mortgage rates go. The other thing to realize is now we have started tightening before we've recovered the jobs lost in the last recession. We're still 1.2 million jobs shy. 1.2 million jobs is about as low as one of the shallower recessions that we've had in the 60s. So that's basically, we're at recession job losses right now already, and the Fed's already started tightening. We have 1, 2, 3, 4, 5 Fed meetings to go, and so they're really going to have to start tightening. If there's a game of chicken underway between tightening and stocks, or the economy and inflation. So one of those, either inflation has to drop sharply, the economy has to drop sharply enough that the Fed gets scared of recession, or the market has to drop sharply enough and look like it's continuing lower enough that the Fed gets worried about a self-reinforcing negative feedback loop, and the biggest risk shifts from inflation to fighting recession. All of those things are likely to be tough for stocks to rally and be a backdrop where they're actually set to decline. And then I'm sure that Chuck will talk about this more than I am. This is the junk bonds. It's a long-term chart. Just want you to realize that junk bonds are much more negative than the market. That sends a bearish message for stocks. All right, let's take a look at some things here. So this is the S&P, and the S&P today clearly broke through this 4056 level. So the next really big support level is this 3400 to 3800 level. We could certainly capitulate further, and we've already started capitulation, which can be a good thing. But remember that capitulation can bring two things. It can bring either a strong demand response, in which case it's putting in some sort of an intermediate term bottom at least, or it can bring on more selling. So capitulation is is fine. You can, maybe if you've got shorts, you get more capitulation, another 90% down day or something like that. That's the place to start taking profits, but you don't want to do anything until you get that demand response that shows that prices have dropped far enough that now longer time frame buyers are coming in size. And capitulation, of course, sends markets down quickly enough that you reach those very quickly. So we're watching for capitulation, further capitulation, and a demand response. We do not have NYHL divergence right now. We'll need a few days of that before we get a bottom that we would want to buy any kind of demand response of. IWM has led on the downside. It broke down before the broad market, and it is leading on the downside in terms of relative strength, making new relative strength lows today and leading the market lower. That was the Achilles heel. That was a big warning for the market back in November, December, prior to this peak. And so that's really has to shift when we see a turn. Okay, and there are some sectors that are definitely in bear markets, sectors that are really dependent on interest rates, such as innovation, where they don't really have growth right now. It's all growth in the future that's being priced in. Those tend to be the most sensitive to higher interest rates, as we've talked about before. ARKK, which is basically an innovation ETF, is now down 74% and counting. FFTY, the growth IBD 50 is now down. This is yesterday, this is as of Sunday, down over 42% at count. All right, let's take a look at supply and demand. So we can see that we're certainly in a negative posture still. With a real thing to watch at this point in time, certainly we watch the supply gauge in blue. The supply gauge, remember, moves in the opposite direction of the market. So when it's trending up, that's negative. Right now it's trending higher and above its 40 DMA, and it made new highs today. So that's basically saying that the market's likely to continue lower. Demand continues more neutral. It is below its 40 DMA, but it's kind of trying to trend higher and holding up much better. But the net of the two, which is what we're really going to be watching closely if we don't get a correction over signal and the market starts improving, we really need for this, the net of the two, demand minus supply, the spread index, to be breaking above its downtrend line, breaking above its 200 DMA, and above its 40 DMA, made new lows today, I believe. And that's the same picture we're getting from major internals. You can see the advanced decline line, the debt points, and the OCO advanced decline line are making new lows ahead of the market and continue being weaker than the market. That suggests further downside for the major averages, absent a correction over signal, which requires a strong demand response. We are getting to overdone sentiment levels, but you got to realize sentiment can get overdone at the very beginning of a move. It just signals that everybody's negative. It doesn't signal that there's been a turn in that. And what you really need is a turn. Sentiment indicator is kind of like divergence. It's a condition, not a signal. What we need now is a signal. Yes, if we get that signal and this condition is in play, it's likely to be a better quality signal over the long run. But right now, this doesn't mean a lot. We could still be declining for many months and even the rest of the year, and this would continue to play around. But it does tell you that if we do get a signal, a correction over signal, that we could have a very decent bounce off. The other thing that is noteworthy from this earnings season that's getting to be long in the tooth is this is the first time in a long time where earnings misses are getting a much bigger hit than earnings beats are getting a plus. And that's a negative environment for stocks. Now, we are waiting for a number of intermediate term oversold indicators to get there, and they're not there yet. So for example, the percent of stocks below their 30-week or 150-day moving average normally get below 20 and below the Bollinger Band at these green lines show you the past cycle lows where that happens. So they have like a handful of these, and some of them are getting close, but they're not there yet. And generally, this kind of a decline that we're in now, you're going to get intermediate term levels of oversold before you get a catchable bottom. The other thing, example, I guess is another chart that didn't come out. The 5-day rate of change usually goes below 5%. That means over the last week, prices are down 5%. That's a kind of a signal of capitulation. You often get at major lows. Today, we broke below the 100-week moving average in the S&P, which generally is associated with some of the bigger corrections or bear markets. Did have that happen in both 2011 and 2016, which I think are good analogs for what potentially we're looking at, although this could certainly morph into something worse. And then realize that we're in the worst 6 months of the year seasonally, and we're also in a period, this is the midterm election year of the presidential cycle, and the second quarter is the weakest quarter. The third quarter is usually not very strong. We usually get bottoms in the midterm election year. Certainly June to October encompasses almost all of them, but August, September, October is where most of them occur. So we still may have some downside to go for a while, but realize that that bounce off of the midterm election low averages 30% over the next year. So if we can avoid a recession and we get a nice correction over signal, there's good potential for us to get some traction out of this, even if it doesn't make new highs.